We will start with two brief presentations. We're going to start with Jason first, followed by Chad, and then we will have about a 10-minute discussion, and we'll open up to questions from the audience as well. I'll let you start, Jason.
Thank you, Judy. Yeah, I'll just stand. And good morning, everyone. Actually, I cannot see my slides myself. Okay. Good morning. So I'm Jason Yee from S&P Dow Jones Indices. As Julie mentioned, I cover factors and dividends, mainly, the strategies or indices that comes with a bit of like, active, well, nowadays active passive is quite blurry, right? With a bit of like active strategy behind the traditional, you'll think of like broad market cap weighted indices. And for those of you who might be less familiar with the factor world, maybe I'll start with, defining what are the factors. Well, we just have a nice breakfast in front of us. I think of factors as like the basic nutrients that in our daily diet. If you think about, the food that we eat every day, what our body really needs are the nutrients. It's the proteins, the fats, the carbohydrates behind those foods, right? But then you can think of this, each plate in front of you is like a portfolio. You have a diversified portfolio, and what you're really getting behind your portfolio returns, those systematic driver of the performance, these are the factors. These are the sources of the drivers in terms of your portfolio returns over the long term. So that's how to think of like visualize the factors in terms of like an analogy. What's driving the factor growth? If you think about the global ETF space today, on the ETF side, factor ETF is probably $2 trillion of assets, depending on how you classify them into the group. But over the past 20, 30 years, we saw that this group of, factor-based or smart beta investing really kind of grow in the 20, 30 years horizon. And there is some of the theoretical background, and that's part of the thing I like about the factor investing. So if we take back to like 40, 50 years ago in the 1960s, 70s, when Harry Markowitz and William Sharpe, they came up with a capital asset pricing model. Back then, for active managers, they can tell you like, this is my portfolio return, this is my brilliant strategy. It's very difficult to understand where that performance comes from. The CAPM model tells us that, well, you have something called the market beta, where you are taking the market, exposure, you are compensated by taking the market risk. And on top of the market beta, you have this excess return, so-called alpha. And that's our understanding of like how to look at active management in like 40, 50 years ago. And then move forward in like 1980s, 1990s, there are a lot of financial literature that came up talking about, well, CAPM is not a perfect model. It's not a great model, in fact. There are things that CAPM just cannot explain in terms of return differentiations. And there are researchers, like Professor Farmer and French, they come up with like, 3 factors, 5 factors, and there's a worldwide research in terms of nowadays, like we call factor zoo or factor wars. But what really it tells us is that on top of the market beta, you have other factors or smart betas that are giving you some of the systematic exposures, and as a compensation, you are getting some of the excess returns. So what you can look at is that it squeezed the traditional so-called alpha to a higher level. So some of the traditional alphas that people think about in the 70s or 80s, now when you look at from the factor model perspective, the manager is doing nothing but having some exposure to some momentum stocks, to some value stocks, to some quality stocks, right? And those are very commonly researched factors. And what you can do is that, well, factors, they can be easily kind of created or published through an indexing approach because these are rule-based systematic ways of constructing a portfolio. So as we can construct factor indices, the ETF issuers can use factor indices to package them into the ETFs, right? Which is, again, a low-cost systematic rule-based approach. So now, instead of paying a traditional active manager a quite expensive fees, you can get some of the factor exposures in a relatively cost-efficient manner. And now what you really need to look at the active management side is that, well, if I control for the market beta, now the market beta is very, very cheap. On top of market beta, if I control for extra factor exposure like value, quality, momentum, what else do you deliver? Are you justifying the fees? And that's what we see, right? The growth of the factor investing, because you can easily get those, ETFs through factor approach, be it single or multi-factors. And at S&P Dow Jones Indices, we have been, frankly, like doing factor indices for more than 30 years, back in the 1992 with the first kind of batch of factors, or we call style factors, the value and growth. And then we developed the single factors and to the multi-factors. Recently, we have been spending a lot of resources in terms of the GARP factor, growth at a reasonable price, and I'll talk about that a little bit more, because it's just a very nice way in terms of blending a couple of factors together. And if you look at our offerings now, we have offer factor indices across different markets, different regions. In Australia here, under our S&P ASX 200 umbrella, we have the single factor family, we have the S&P ASX 200 GARP. And also if you're looking at outside of Australia exposures, the developed market, we have a suite of developed market single multi-factor indices. And today I really want to highlight on the S&P World X Australia GARP Index. So GARP stands for growth at a reasonable price. Essentially, you are looking at the growth characteristics, but you're also considering valuations quality into the construction. And I can give you an example. This is how we can do this through an indexing approach. It's very straightforward. So first, your starting universe is S&P World X Australia. This is basically your large mid-cap exposure outside of Australia. And then within the broad markets, you start with a growth screen. So growth we define as 3-year EPS and 3-year SPS, sales per share growth. And you use that two matrix form a composite growth score. You select the companies with the top 500 stocks, in terms of the growth score. That's your first screen. So now you're left with the 500 stock growth universe. Your second screen is we look at something called quality value composite. So the quality value is defined as return on equity, leverage, and earnings to price ratio. So you have two matrices on the quality side, one matrix on the valuation side. And we combine them together, form something called a QV, quality value composite score. And within the 500 growth universe, you select top 250 by the quality value score. And your last step is you weight the companies by the float market cap times your growth score, and it's subject to some of the capping and diversification constraint. The index is rebalanced on a semi-annual basis. So you can see this is just a step-by-step of very straightforward kind of index construction and what it does to the historical performance. It outperformed the broad benchmark, the S&P World X Australia, by quite a big margin. If you look at annualized compounded return, we're talking about 2 to 3% per annual over the long term of the excess returns. And that comes with about 4 to 6% of the tracking error, depends on when you look at. So this gives you like a bit of, a strategy flavor on the GARP, but in an indexing approach. And in terms of performance characteristics, the GARP strategy, if we break down into like the markets into up and down, so the up is when the underlying benchmark is positive in the monthly returns, down is when it's negative. So it's more likely to outperform in the up market. So about 60% historically, and this is like over 20 plus years of the backtest, the GARP index outperformed the underlying benchmark. And when the market is down, it outperformed only about 48%. So it's a little bit more like offensive, cyclical. If you look at something like dividend, it's the other way around. Dividend is more likely to outperform when the market is down. It's more defensive. And this is just another one, if you look at, the index, how it's delivering its objectives in terms of the characteristics. So here is a it's a quarterly average of some of the characteristics like growth, so EPS, SPS growth. The GARP index did much better. They have much higher growth historical characteristics than the underlying benchmark. And also, if you look at valuations, the valuation on the PE ratio is slightly lower than the benchmark. And on some of the quality matrix, it's had better ROE, ROA, and also the operating margin and leverage ratios. So overall, like the index designed for its, purposeful in terms of growth at a reasonable price. So just quickly conclude here. So what we talk about today, first, what are the factors? Well, the factors, they're really the drivers of the diversified portfolio returns. Think of them of your daily nutrients on your diet. And the growth of the factor investing over the past 20, 30 years, there is really a theoretical asset pricing model behind those in terms of moving from the traditional market beta exposure to some of the smart beta systematic risk premium exposures. And we use S&P World X Australia GARP index as an example just to walk through how to construct a factor-based index and what its historical impact looks like. Yeah, Julie, back to you. Thank you.
Thank you, Jason. And that was a very good overview. I was actually thinking if you are not doing your day job, you will make a great university academic.
Thank you.
Chad, I will hand on to you.
Okay, awesome. So I'm in the habit of diving right in. So let's dive right in. I'm Chad Hitzeman, one moment, from Global X Exchange Traded Funds. This is going backward, not forward. One second. Okay, here we go. Am I going backward or
Yeah, you're
forward?
going backward. You
Because
want
it
to
looks like
go
it's going backward, forward.
Yeah.
Okay. Wait one moment. It's going in circles, in fact, it looks like. Oh, you had additional extra slides.
Yeah,
Okay,
all the appendix.
Jason, okay.
We do a lot of appendices.
Here we go. So I'm Chad Hitzeman from Global X Exchange Traded Funds. Delighted to be here this morning. 2025 has gone by in a rapid clip. It's hard to believe. There's never been a dull moment, even on weekends when markets are supposed to be closed. So I'm going to carry on and take the baton from Jason in continuing a conversation on growth at a reasonable price investing approaches. So at Global X, we run two GARP strategies, one of which is over international equity universe, the second of which is over the domestic equity universe. So before we dive in covering GARP left to right, back to front, a bit of obligatory biographical background about who we are. So Global X, we're a global asset manager, roughly covering 900 billion in assets under management, US dollar terms, across ETFs, managed funds, private equity, venture capital, real estate, and so on and so forth. Here in Australia, however, we're specifically focused on exchange traded funds, and we're very multi-asset in our offering. It's always good to have a mind toward asset allocation. So covering off each of the buckets from international equities, plain vanilla, thematic, domestic equities. We're talking about factor investing as well. We cover income solutions in terms of covered calls, fixed income. And lastly, we cover liquid alternative diversifiers, principally in the form of gold. So Global X historically in Australia, we've been the dominant ETF provider for gold. We have about 6.2 billion in assets under management for that non-correlation tool. It's the purpose of gold to our mind's eye. Okay, so this is going to be a speed dating speed round overview. And I'm going to tee up the conversation firstly by providing a bit of lay of the land with respect to the equity markets, global equity markets, where they stand. And from that, I'm going to basically tease out an investment case for growth at a reasonable price approach. The first observation, one second, I think these slides are a bit different, in fact. Okay, that's okay. So, okay, there's a bit of a mismatch. So the three observations, just rolling with it. The first one is basically that you can find quality and growth stocks. So if you actually looked at, for example, quality factor being profit margins, growth and quality are neck and neck in terms of profit margin exposure, in terms of 20% plus profit margins. The other thing I was going to point out was that year to date, the style factor or factor that has proven to be the best performing is growth, followed by value, and then followed by quality. So growth this year has done around 16%. You've had value around 13%, and you've had quality around 11%. So basically from that observation, I was going to say, it has made sense to basically have a growth tilt on your global equity portfolio, but being mindful of relative valuation. So in other words, the GARP investing strategy is to look within growth pool and select from it those at a reasonable price. The other observation, the second observation I wanted to tee up looking forward into 2026 and 2027 is that market consensus expectations of earnings growth. It looks like things are going to broaden out to better earnings per share growth profiles found in Europe and Asia. And so in other words, having basically a mindfulness for global equities and being able to stock select within that larger selection pool and picking out the companies that exhibit most strongly growth at a reasonable price attributes. And the second or third and last final observation and teeing up the proposition for GARP investing is that if you look at international equities, specifically US ones, valuations are quite high. And so again, GARP is mindful of valuation. If you looked at the CAPE ratio as it stands today in the US on the S&P 500, the magnitude is well above the 50-year average and well above the longer-term data, which dates back all the way to the 1900s. And okay, so this is actually a relevant slide to the right, and it basically shows that the higher the PE, so the price at which you purchase the stock, tends to be negatively correlated with 5-year future returns. So in other words, you purchase the stock at a high price, forward returns are perhaps lower. So that basically tees up for the next part, the next phase. So I touched on the fact that GARP is inclusive of growth factor, inclusive of value factor, but as a matter of fact, it also encompasses quality. So what we're doing is we're going to the growth stocks, we're selecting among them those that have comparatively more favorable PE ratios, and also those that have quality factors in terms of the least financial leverage, as well as the highest return on equity in terms of capital efficiency. So we started running this strategy on the basis of an S&P index, which Jason touched on, in September 2024. And since we launched it, it's outperformed the single factors across the board: momentum, company size factor, value factor, quality factor. In over a 7-year period, it's done the same. So a longer time horizon. Interestingly enough, also, it's achieved a lower level of volatility against the single factor growth and the single factor company size. Jason did a really wonderful job in laying out how we basically stock select to curate a global equity portfolio that's postured toward growth at a reasonable price. And so again, we along those 3 factors for growth, we're looking at companies that exhibit the strongest 3-year earnings growth, sales growth, quality, highest ROE, lowest financial leverage, and then looking at the style factor. And from that, we filter down to a 250 stock portfolio. And to the right, I wanted to show the top 10 holdings of the GARP portfolio as it currently stands. And because it's a systematic, index-based, rules-based approach, you can very transparently see why a stock, as at the rebalance date, has been included in the portfolio. So looking at each of those metrics along each of those style factors that I pointed out. So now we really get to the question, well, how has a GARP portfolio performed against the total market world portfolio? So think MSCI World. So if we're trying to stock select for those profiles of high EPS growth, high sales growth, not too much financial leverage, high return on equity, with a mindfulness to the PE ratios, trying to take the least highest PE among the growth stocks, how have we done against the world portfolio? So along each of those considerations, each of those factors, it's proven to be better. And we've also de-amplified the PE risk. So the growth portfolio, growth at a reasonable price, is about 20 times a multiple, whereas the MSCI World is about 24 times. In over 3-year, 5-year, 10-year performance periods, there's been an excess return that GARP's achieved vis-a-vis the MSCI World of roughly 3%, which Jason touched on. Drawdown behavior. It's very comparable to the world equity portfolio. Sometimes, however, it will draw down a bit more sharply, but it exhibits stronger bounce back power in the context of where and when a recovery occurs, so upside capture. So now these, keep in mind, are a bit different, the slides, but that's okay. So I actually wanted to close by showing how the GARP portfolio rebalances, because that's the time at which you can see its selection choices. So you can see how it does the stock selection in terms of additions, deletions, and allocation effects in terms of geographies into which it tilts and so on and so forth. So the GARP portfolio rebalances twice a year. So that's the occasion on which we revisit the universe and we stock select again. And on December 2024, we actually took Tesla out of the portfolio. And if you see, you can see that the blue line, Tesla's PE had rapidly escalated. So that was the reason for the deletion. And subsequent to the deletion, Tesla's share price fell. So that seemed to have been a good stock selection choice. That's just a mere sample. There's other things that we could talk about. Uber Technologies was entered into the portfolio at that time, as well as a Spanish financial holding company, BBVA, each of which, after that December rebalance, did very well. Now, very lastly, to wrap up, I wanted to point out on its most recent rebalance this year in June, the portfolio tilted into Japanese equities because there was earnings momentum there and relative value to be found there. And after the June rebalance, you can see that Japanese equities outperformed the MSCI World as well as the S&P 500. So that's that. Thank you so much.
Thank you, Chad. Very thorough overview. And as you can figure out, GARP is very much front of mind at S&P and Global X, very timely given our recent launches. I wanted to start the conversation by maybe going a little bit more broad. The topic is on global factor strategies. So maybe I'll start with you, Jason. Can you maybe summarize some of the key trends that you're seeing with global factor strategies, especially with the growth and development that we're seeing with index-based strategies?
Yeah, of course. And I'll keep it high level. So I think three major trends. One is income thesis resonates across the world. Whether you look at the US market here in APAC, Australia, income yield generation, this is really super resonating from the fixed income space to the dividends in the equity side to the covered calls. People are building diversified different approaches in terms of income generation. The second theme, if you look at on the single factor side, quality and momentum has done really, really well over the past 2-3 years. We have an S&P 500 quality and S&P 500 momentum in terms of ETF assets tracking those is just booming over the past 3 years. And it's in the very good performance cycles. And the factors or the fact indices that delivered, what the objective hope to achieve. And lastly, we see some of the new kind of we call factor 2.0 factors that are not in your traditional definition, like free cash flow. We also have Aristocrats franchise in the dividend side. So some of the innovative products coming out to the market.
Thank you. And Chad, would you like to add your perspective to that?
So at Global X, we canvass a wide variety of strategies. So one of which is the growth at a reasonable price approach applied to international equities as well as domestic equities. We're always in search of interesting investment areas, either for tilting purposes or more core buy and hold positioning. And keep in mind, the great thing about being multi-asset is we can enter into any area. So I flagged the fact that, for example, Global X were very heavy in liquid diversifiers in the form of precious metals, so that non-correlation tool. So we can go and look at commodity strategies. We can look at income strategies over fixed income. Fixed income is interesting because from a factor point of view, there's certainly been conversations about whether or not there's factors existent within the fixed income space and whether or not you can equally seek out factor returns in that area versus the equity area. And I would be interested, in fact, to hear S&P's thinking on factor investing with respect to fixed income, which would be interesting.
Yes. I don't know if Jason would like to comment on that. We will actually have our PM for fixed income here in November.
Yeah, but in terms of, I'll quickly address like some of the common factors. We do have a fixed income factor indices and franchise in terms of in the strategy flavor. But some of the examples like you can look at yield, you can look at duration, like just similar to the equity approach. You can use kind of the systematic rule-based way in terms of how you construct your fixed income bond portfolios or bond index, and then tilting a little bit towards when the market is like a higher risk or higher credits or longer durations. That type of approach definitely also exists in the fixed income side. Yeah.
I know at Global X, you have quite a wide range of ETFs now. You're 47 for launch. I can only remember that because it was actually at the launch 2 weeks ago, which happened to coincide with being the 400th ETF launch on the AXX. So that is my little bit of history that I'm going to remember being there. Chad, I know while you and your colleagues speak to financial intermediaries, which are represented here, you may deal more with institutional clients, but your colleagues are, speak to asset managers, financial advisors, wealth, family offices. Where is the main interest in factors? What are they asking for? What are you seeing in your conversations there?
It's interesting. Usually some factor expression, just zeroing in on GARP, is expressed typically through active managers. So right now we're going through a process of basically changing mindset that you can achieve consistent, systematic growth at a reasonable price exposure on a domestic equity basis or international equity basis through a systematized index approach. So really that's the feedback, and also is, how do I time the factor? And the great thing about having something of a composite factor approach is that you have a little bit of everything. Otherwise, you're thinking about, well, do I rotate into this factor? Maybe it's value at this point in time, but then what's the point in time that I go back to another factor, or this, that, the other? So those are the type of conversations we're having. Basically, GARP through index versus active, and then just talking about the other item that I mentioned.
Moving on to our next line of questioning, implementation. I know for many of us here, we see the end product. We really don't think about, what happens getting the product to that stage. Jason, can you maybe comment on some of the challenges to implementation, especially when you're trying to work out the methodology? And I know with GARP, well, when, dealing with single factors can be challenging enough. And when you're trying to do multiple factors, that adds further complexity.
Well, so first of all, I think GARP as a bit of multi-factor, because you have the growth layer, you have the earnings to price valuation, you have the quality considerations, and it's a two-step kind of sorting approach. So I do see that it's much more complex than a traditional, just a value single factor or quality single factor approach. But I think from my perspective on index construction, I always say that the devils are in the details. Even one line of the difference in index methodology could lead to a very different outcome in the index historical backtest performance. And just take we have the S&P World X Australia GARP, we also have the S&P ASX 200 GARP. Those two comes with slightly difference. Just for example, the S&P ASX 200 GARP, it take out the leverage ratio from the quality matrix. Why? Because we look at the empirical studies and we found that financial leverage as a matrix itself is just not super robust in the Australia. And Australia market, you have very concentrated in terms of the 5 big financial companies. Does it make too much sense in terms of using the leverage compared to financials versus non-financials across the board? So that puts a question to the methodology, and we actually modified slightly to better fit the local market dynamic. Yeah, so a bit more on that. So the ASX 200 GARP is essentially you start with the S&P ASX 200, you select top 150 names on the growth score. So the growth is the exact same definition. Step 2 on the 150 growth, you select the top 50 names by quality value. So you really, within the growth, amplify the impact from the quality and the valuation. And here on the quality, we're just using ROE, return on equities, which is a very robust matrix across the world. And then on the earnings to price. So all of the matrix we use is the same. The change here is 1 on the screening, on the selection, target stocks. 2 is we get rid of the financial leverage. Yeah, and then the weighting scheme is, this FMC time the quality value. So again, we put more emphasis on the quality value side rather than the growth. Because the growth itself, the 3-year is kind of cyclical, and Australia tend to be more cyclical than some of the other markets, right, as you see. So that's why we modify some of those. And in terms of the results, we have a paper on that, and feel free to check on our website, in terms of, what it looks like historically. Yeah.
Before I hand over to Chad, I think there's a question in the back corner.
Yeah, look, it's actually a question mainly for Chad. With Global X, Chad, you were talking about you were dropping this stock and picking up that stock. Now, are you just using an index, or are you working the index? Is it your selection, or are you just following an index?
It's great to see you. Actually, we haven't talked in a while. It's index approach, so it's S&P's index, as a matter of fact, that we use as an index partner. And basically, the index serves as a stock selection strategy. Our portfolio managers, on the occasion of the rebalance and reconstitution date, will look at the basically portfolio composition file of the index And on the basis of that, we'll make additions into the portfolio and deletions out of the portfolio, if that answers your question.
And if I can add on top of that, so from the index provider, we emphasize a lot on index methodology. So our index construction strictly follow the index methodology step by step. So you have the data input, you look at index methodology as your menu, and then you're basically, constructing the index. So the outcome, if you look at from, the backward looking, like some of the great examples Chad talks about, yes, like we get some of those numbers and some of the names right. But remember, index is a very well diversified approach, right? It's 250 names. If you look at it, this is not like single stock selection. We are not, picking stocks to your point. We are just using the data input and following the systematic construction. Are we getting every single name right? Maybe not the case. Are we getting every single name wrong? Maybe not the case neither, right? But the key here is have a well diversified index or exposure to some of the factors that you think can generate long-term risk premium excess returns in a rule-based approach, in a transparent approach. So that, I think want to clarify, index provider is not a stock picker. So we do, look at the methodologies, and the methodology is probably available on our website. So feel free to check on that. Yeah.
Unfortunately, I think our time is up already. That went very quickly. Thank you, Chad and Jason.
Thank you so much, Julie.